Hi, I'm Matt Bellingham from Bellingham Wallace. We're a chartered accountancy and advisory firm. Been working with the Icehouse for many years now, presenting in OMPs and working on through the business planning side of it, and generally just helping businesses grow, and really through focusing on the numbers. You know, being an accountant, that's what we love, and let's face it, at the end of the day, it's all about the numbers. So I'm here today to talk to you around the 3 top tips for improving your balance sheet. And clearly that's going to be around the numbers. So the first thing is don't be scared, because this isn't about debits and credits. This is around looking at just a couple of key numbers, and hopefully you can pick something up from them and make your business go a bit better. Tip number 1 is really understanding your working capital cycle. Now you think, working capital, what's that? Well, basically in English, working capital is, do I have enough money to pay my bills? So we kind of think from an accounting perspective that having enough money to pay your bills is pretty important. So if you want to grow the strength in your balance sheet and have an opportunity to grow your business, therefore you need to understand this thing. It's actually really simple. So here's your first idea. When we start off in business, we start off with a little bit of money. So I don't know where we get that money from. We might, I don't know, go to the bank, or you might rob your piggy bank, or you might borrow it off mum. Whatever you do, probably doesn't really matter. So what we do is we get this little bit of money, so we call that cash. So we start off with that. Now, sticking cash in the bank, last time I checked, that wasn't really a business. So what do we have to do with that? Well, we have to buy something to sell, or we have to make something, or we have to do something along those lines. So what do we do? What do we call that? Well, in accounting language, we call that stock or inventory, or just general work if we're a service business. So we'll call that stock for now, because that's an easier word for me to spell than inventory. So we get our cash, and with our cash we go off and we buy some stock. So life is all pretty good now. Don't really have any cash left, but I've got all this nice stuff sitting in my warehouse ready to sell. What's the plan now? Well, one would say probably a good idea might be to sell it. So let's say that I got lucky and that I bought the right sort of stock and someone wanted to buy it off me. So someone's bought it, and that stock now turns into debtors. So I started off with some cash, I turned that into some stock, I got lucky, I sold that, turned that into some debtors, so that's some people who have promised that they're going to pay me for my stuff. And what happens if I get really, really lucky? Well, they might even pay their bill, and if I'm super lucky, they might even pay it on time. And that money turns back into cash again. And that is what we call the working capital cycle. So what we like to do is measure exactly how long that takes. So how long does it take our cash turn into our stock? How long does our stock sit there before we sell it? Then how long does it take us to collect our money? And we add up that amount of time, and that's how long it takes us to spin our working capital cycle. Now what we want to do is get some numbers around here, get some numbers around here, and then what we want to do is do everything possible in our power to speed it up. So the faster we can spin this little baby, the more money that we're going to have dropping out of the bottom of it. This is particularly important as our business starts to grow, because a balance sheet can get lazy, and I'm sure you've heard of the term lazy balance sheet before. If we just stick a bucket of cash next to a lazy old balance sheet, it's just going to be like a sponge sitting in water. It's just going to soak it all up, and we're really just going to run out of money really, really quickly. So improving your balance sheet, number 1, understand your working capital cycle, measure your stock days, measure your debtor days, and then actually do something about it. Tip number 2, so let's assume that we've got our working capital working nicely. We've picked up our balance sheet and we've squeezed it, and all this cash is dropping out of the bottom and things are going fine. Well, are they going fine? Next most important thing to remember is we've actually got to make some money. So when we're selling that stock, we've got to make sure we're selling it for the right price, and we've got to make sure that we're getting the maximum possible margin that we can out of that. So understanding your margins, tip number 2, absolutely crucial. So what you need to do is work from the bottom up. We need to understand what our costs are. What costs are going, what is every single cost that is going into that product. Ramp all of that together, and then we need to place our margin on top of that. And it's all about the money. So the more that we can make per product that we sell, the less that we're actually going to have to sell in order to cover our overhead costs. It's absolutely crucial. So just leading on from this, know your numbers, understand your margin, do your calculations. There's no substitute for the hard work in here. Don't rely on just a computer, you need your common sense. And then put in place a rule within your business, a rule about discounting. That rule is quite simple, really. Don't discount. Don't ever discount. So no matter how tempted you might be, the second you start discounting that product or that service, it's a one-way road and it's a race to the bottom. So you need to think about all of those different things, and you need to think about the different reasons why people will be buying off you. If it is price, then price to the market and price appropriately, but manage your costs appropriately and understand what bit of that sales price is yours. Without that, you're really going to struggle actually making the whole thing make sense. So tip number one, manage your working capital cycle, speed it up and squeeze the cash out. Tip number two, always manage your margins, always understand your costs, and never ever ever discount, especially unnecessarily, because most people will still buy your product anyway. Tip number three is all about borrowing money. So it's all about debt versus equity. What we call that in the old accounting game is this funny little word called leverage. Now, leverage can be great because what leverage can do for you is it can provide a whole bunch of different opportunities. It can allow us to put a small amount of money into the business, borrow the balance, and really create something pretty awesome out of it. And Kiwis, let's face it, we love debt. We're obsessed with debt. We can't get enough debt. Okay? But this is a little bit different to the Auckland housing market. Here what we actually need to do is understand that business can go south and we will have little blips within the road. And so what we need to do is have enough strength and enough equity within our balance sheet and be appropriately leveraged so that we're maximising the use of our capital. So there's a couple of simple rules that we use on that one. Firstly, understand one or two absolutely key ratios. The first one I like to look at is the equity percentage. So it sounds difficult, but it's actually really simple. All it is working out how much money do I have in the business versus how much money does somebody else have in the business. And we compare that to our total number of assets. And the great thing about a balance sheet is it's always got a balance. So our total assets is going to equal the total amount of money that I've put in plus the total amount of money that someone else has put in. So once we understand those numbers, we can go take the total amount of money that I've put in, compare that to the total amount of assets, and that gives us an equity percentage. So what is a perfect equity percentage? To be honest, everyone is different. So it depends on your own personal risk profile, it depends on what assets you're funding, and it really depends on the actual size and quantum of the dollars as well. We'd like to think that anything under 30% of equity, therefore 70% of debt, you're starting to skate on some pretty thin ice. You really don't have much of a war chest if you're below that 30% mark in case something goes wrong. What's a perfect equity percentage? I would say certainly upwards of 40 and probably trying to get to a 50-50 mark. Then you've got a bit of safety and you've got the ability to use some of the other people's money. So really understand that piece on your balance sheet. Then once you've taken on some debt, it's really important to structure that debt properly, and again, this isn't too tricky. So we really have one quite simple rule around here, and that rule is match the life of the loan with the life of the asset. So that means really if your asset is going to last sort of a period of around 5 years, then don't try and pay it off in 1 year because you're going to get the benefit over that 5 years. So pay off the loan over 5 years. Conversely, it means if you're going to invest in an asset which is only going to last 1 year, so let's say a new computer system probably these days, don't fund that over 5 years because you'll be left with this dirty great bill and you'll have no asset left. So whilst it's common sense, in my experience, which is 25 years of advising businesses, I see this mistake made over and over and over again. And often that can actually lead to the worst outcome, i.e. some kind of liquidation or closing the door. So really, match the life of the loan with the life of the asset is my golden rule on borrowing. To put that another way, never ever suck short-term cash out of the business to fund a long-term asset, because you never know when you're going to need that money, and you never know when that mistake is going to come back and bite you really hard.